Hey Dreamers, I received a question from a subscriber recently on how many stocks one should own in a portfolio. He said, conventional wisdom, for all it's worth, says that around 30 stocks well chosen among different sectors is enough for diversification. And that, well, I've got more than that. And is there a reason why? Hey Eddie, thanks for the thoughtful and really good question. So, this week I'll answer with my perspective on diversification and how I think about the number of stocks to own in a portfolio. So, here we are back in my portfolio, and as you know, I have about 94 different stocks that add up to a total of $1.5 million, kicking off about $70,000 in annual income. And what I've done is actually add this new column here for sector. And you can start to see I've got consumer staples, communication services, healthcare, energy, infotech, financials. And then I also added a column here for geography, just to see how diversified I am from a geographical perspective as well. So, taking a look at overall diversification by sector, this is how my portfolio breaks down. I've got 18% in consumer staples, 17% in communication services, 14% in infotech, 13% in financials, 13% in healthcare, 11% in real estate, 6% in energy, 4% in utilities, 2% in industrials, 1% in consumer discretionary, and then some various other things. In terms of geography, I've got the majority in the US, 78%, and then I've been building up my Canadian exposure, as you know, to now it's 13%. International, which is essentially Philip Morris, 5%, and then the UK with things like BTI and GSK at 4%. Now, this is a little bit of a misnomer, right? Because some of my top holdings are things like IBM, Pfizer, J&J, Microsoft, and these are companies that are definitely international in scope. So, for example, IBM operates in 175 countries, Pfizer operates in 55 countries, and Chevron operates in 180 countries. So even within the US exposure, I've got quite a significant international exposure as well. But that still doesn't answer the question, why don't I try to get all of that diversification inside of just 30 stocks? In other words, why not just stop here instead of have all this other stuff down over here? So let's take a look at what the quote-unquote experts say on how many stocks you should own. Well, you can read 100 different articles, but essentially they start to boil down to this, that anything under 20 starts to become more risky and very highly concentrated because you're exposing yourself to single security risks. And then you also see this very commonly written advice that some experts say that somewhere between 20 and 30 stocks is the sweet spot for manageability, diversification in most portfolios of individual stocks. But it goes on to say that other research has pegged the magic number at 60 stocks. Wait, what? A study completed over a 15-year period by Roxbury Capital found that when portfolios have 60 stocks or more, that investors achieve an 89% diversification, meaning your portfolio is protected against volatility. That's a bit confusing. So, is there such a thing as owning too many stocks? A recent Motley Fool article asked the exact same question. And here we go again with the general rule is to aim for 20 to 30 stocks. A discussion with experienced investors does go something like this. Hey, I've done well owning the same 15 stocks for decades, while another person says, well, I own 50 to 60 different stocks and I've gotten the exact same results. And I've found a key difference between those two different kinds of investors is the willingness to be able to put the work into selecting those 50 or 60 or more different stocks. So at this point, you may be thinking, I'm confused. Do I own 20, 30, 40? How many stocks do I own? Well, let's turn to the Oracle of Omaha, Buffett. The question is, how many stocks does Buffett own? Well, there are many places you can look into his entire stock portfolio, and the answer right now is he's got about 42 stocks in his portfolio. But if you've followed Buffett for a while, you know that he regularly sells and buys in different quarters, and recently divested of 10 stocks and then added 7 more. So his numbers go between 40, 50, something in that range. So next you can look at, okay, what if I was a mutual fund manager? How would I craft a mutual fund? And you can look at something like T. Rowe Price Blue Chip Growth Fund to see how many positions are held in that fund. And so down here you can see that there's actually a concentration at the top of 56% in the top 10 holdings. But down here at the bottom, you can actually see this little footnote that says that there's 91 holdings in this particular mutual fund. Let's take a look at another one. Very popular mutual fund, Fidelity Contra Fund. And they have a concentration in the top of their portfolio of 49% for the top 10 holdings. But once again, the footnote at the bottom here is 354 holdings in total. 354 for diversification. And I know this should be obvious, but maybe not. The biggest mutual fund out there, the Vanguard 500 Index, has a concentration of 28.84% in their top 10 holdings. But in total, they have over 500 holdings. So there's a recurring theme here of concentration at the top, yet a long tail of stocks at the bottom that you can see here in these mutual funds. And the same is kind of true with Warren Buffett, because 87% of his portfolio is in just 3 sectors. So Warren, what are those sectors? Well, his top sector is infotech at 45%, and really the bulk of that is Apple stock. The second sector for him is financials at almost 30%. Bank of America is actually his second largest holding. And to round out his top 3, it's consumer staples at 12% of his portfolio. So that brings me back to, what is my strategy? And how do I think about the number of stocks in my portfolio? I'm going for steady, safe income with concentrations at the top, not unlike Buffett. But also, I want to balance with great diversity and some risks in the long tail. I have concentration in the big, stable dividend kings and aristocrats for income protection and wealth preservation. But I also have value plays, growth plays, and experiments going on in my long tail. I've actually recently consolidated down from over 100 stocks to 94 and may consider consolidating further. So what are some of the pros and cons of going more than 30 or 60 and being a long tailer like me? Well, based on my experience, one of the cons is that it is more difficult to manage and keep up with researching companies. And another con is you could be betting on big known names and just set it and forget it, like everyone else. But then you do get the exact same results as everyone else. So maybe it's lower stress? Some of the pros from my perspective is that I get greater diversification and experimentation, and that helps me keep my eye on and might even inform some bigger plays that I want to make in the future. It also gives me the ability to leverage my unique knowledge set. If I know what's going on a little bit more in tech or healthcare or whatever based on my own professional experience, I can make bets others can't because I'm able to read the tea leaves with a better lens, and therefore maybe perhaps a little better able to predict what will happen. Another pro I like is that I get paid on more days, so it pays me out pretty evenly throughout the year from an income perspective. And I think I just get the best of both worlds. Get safety and concentration, with also the ability to learn and grow with some more risky bets in the long tail. So, with all that said, what should you do? Well, to me, the number of stocks in your portfolio is arbitrary. It really is a matter of you being well diversified enough to match your risk tolerance. It's a matter of you being paid out in a way that will support you throughout the year. It's also a matter of leveraging your unique point of view and knowledge. And lastly, it is a matter of how much time and energy you want to put into monitoring your stocks. For me, in the future, I don't see going below 75. Although, again, I feel like I'd go up and down depending on what's going on. All the while, as you know, staying a long term investor with solid consistency for the most part. Okay, Eddie, I hope that helps. Thanks for watching, and as always, I encourage you to do your own research, decide your own strategies, and keep learning. And the disclaimer, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.